We can do better again. Thank you so much. Thank you so much, Mr. Richard Arthur Esquire. That was very, very insightful. Ladies and gentlemen, we are still on the program. Let me quickly mention our organizers. So this has been made very possible by the Financial Awareness Foundation, Center for Financial Literacy Education Africa, Chartered Institute of Bankers, and the FA Association, University of Ghana chapter. We also have very strategic partners that include Access Pensions, Pali Global, Pro Material Limited, Prudential Life Insurance, KPMG, Ghana, Deloitte, Crescendo Consult Limited, Ghana Association of Bankers, the Ghana Think Foundation, all our media partners, and then Bliss Ben Deco. Bliss Ben Deco. Thank you very much for partnering us. I think in the course of time, I will invite 3 of them to tell us a bit about themselves and what we do. And I'm sure that all of us will be beneficiaries. So the next person I would want to invite, one of the mistakes I tried making some time ago was to try and find the full meaning of KPMG. And when I got the meaning, I said, no, there's no way I will try mentioning this because I was going to make mistakes. So let me keep it in my head. So if you want to know, you can also go and search for the meaning of KPMG. It's a very long thing, and my goodness. So we are blessed this morning. This person has led various teams for numerous tax advice for many companies on both domestic and international tax matters across sectors that include energy, mining, construction, financial, consumer and industrial markets in West Africa. She's been involved in providing the quality and technical project management support, in providing quality services to a number of clients in a broad range of industries. The good thing is that she provides tax assistance to foreign companies investing in Ghana, including the free zones enterprises. She holds a Bachelor of Arts in Economics and Statistics from the University of Ghana, and then professionally she is a fellow of the Association of Certified Chartered Accountants, ACCA UK, and a member of the Institute of Chartered Accountants, Ghana. She is speaking on tax implications on estate and gift planning. I want to invite Madam Justina Amartey-Kwei, a senior manager with KPMG with over 10 years experience. Oh, let's do it for her. Thank you.
Thank you very much, and good morning to you all. Thank you, Mr. Efa and Mr. Arthur, for taking the lead on the legal aspect. I'm happy to bring on board the tax aspect of estate and gift planning. Financial literacy for me is essentially equipping individuals with the knowledge and skills they need to make efficient decisions with their financial resources. So the importance of tax cannot be overemphasized in this whole knowledge building process. Because in planning your estates and gifts, you need to know the tax implications of your day-to-day decisions to be able to plan appropriately and take advantage of any tax planning opportunities that are available to you. Year on year, we are likely to receive gifts in the form of estates, transfers, etc., without necessarily considering the tax implications of these gifts. It could be that we are not aware of them, which is why the month of awareness is really beneficial and we need to take advantage of it. The tax implications of gifts and estates have evolved over the years. And I'll take it from PROW 2016. So PROW 2016, we had this under the Internal Revenue Act 2000, Act 592, which clearly provided for how gifts and transfer of assets should be taxed. It further took into consideration the circumstances of the transfer, which clearly excluded transfers under a will, transfer from a spouse to the other partner, a child, or relative. And then also provided a specific rate at which the value should be taxed, which was 15%. Now, fast forward 2016, we have the coming into force of the Income Tax Act 2015, which is Act 896. Now, this act as well has provided that when you receive a gift or you make a gain from the transfer of an asset, you, depending on the source of this gift or the asset that is being transferred, you either include it in your business income, if it is coming from your business activities, in your employment income, if it is coming from your employment, and then in your investment income, if it is as a result of your investment. This Act further also considered the circumstances of the transfer, which again excluded the transfer under a will. That one was a clear exclusion under this new Act. However, when it comes to transfer to spouse, children, relatives, associates, etc., it's provided a base, okay, which is tied to the time of receiving this gift or transfer. So it is really important for us to consider whether whatever asset in question is actually being transferred under a will or being transferred as a gift, what the tax considerations or the tax implications of this transfer would be, and then also understanding and knowing the possible tax planning opportunities that are available under the Act. And I'll take a few examples. For example, transfer of shares are done of a company to, let me say, a child of a beneficiary or a holder of these shares. At the point of transferring these shares, will we consider it as a transfer of assets for which the gain from this transfer should be included in the income of the recipient, which is the individual? Also, on the side of the transferor, what are the tax implications? Will this transfer result in a gain? Because to the extent of any gain realized on the side of the transferor, there are definitely tax implications that needs to be considered. Unless all of these are happening under the will, that is where we have the clear exclusion from the law. So it is important for us to consider whether the transfer actually will result in a gain on the part of the transferor, because the implications actually go both ways. The recipient has his or her own implications to consider, and the one transferring also has his or her own implications to consider. So at every point, we need to know what the impact of the transfer is in this whole planning process. We also need to know, for example, in the transfer of land and building, and I know Mr. Atta talked about the documents and things that we need to consider. But in transferring land, at that point, we need to know what that land represents. Is it a capital asset? Is it an investment asset? Is it a transfer under a will? Is it a transfer that is resulting in a gain? Because in the case where there is consideration involved, we now need to consider whether the consideration actually exceeds the original cost of this asset to be able to establish the gain. In the case where there is no consideration, the law actually provides in certain circumstances that the market value of the asset is used in determining the base for the taxes that need to apply. So we need to consider whether this land is coming in as a sale or a transfer that is resulting in a gain. And again, the exclusion is only under a will. So the key word around all of these transfers is to know whether it is going under a will or outside the will. Then at that point, you need to identify whether it is going as a result of your business activities, as a result of your employment, as a result of an investment, or as a beneficiary of a will declaration. Now we can also look at trusts, okay, using the trusts as an avenue of planning our estates. When it comes to trusts, the law itself considers the trust as an entity. So the profit of the trust is required to be taxed, okay, just as a company will be subjected to tax. However, the distributions from a trust are considered exempt. And the key consideration here is that the trust must be resident for this exemption to apply. So it means that if you become a beneficiary of a non-resident trust, that gain or income you are receiving will have to form part of your assessable income for the year. But if the trust is resident and the distribution is in the hands of the beneficiary, it is considered exempt. So these are things that are very important, and you know that to the extent that you are able to plan your taxes well, it actually goes a long way to help you realize tax savings, minimize your risk of tax exposures, and also help you improve your tax compliance, which ultimately helps reduce any additional costs that you are likely to incur as a result of penalties or interest associated with non-compliance. So the key takeaways here for us when it comes to the tax implications of estates, and I have said it through the examples that I have cited, is to first of all consider the assets in question, the assets that is being transferred, and its status in line with the definition of realization under the Income Tax Act 896, which is Act 2015-896. Realization is defined as whether it is being transferred, sold, or given out completely to another party, okay, in the process of exchange. So at that point, you need to know whether whatever asset is being given out as a gift or being handed down to you as an inheritance actually qualifies as realization under the Act. The second one is to know whether there are tax implications of this transfer of assets that you are receiving, either as a gift or as an inheritance. And I earlier mentioned that Act 592 provided a specific rate, but under the current Act, it is going to form part of your income. So if you are a business, it will be taxed at 25%. If you are a resident individual, it will be taxed through the graduated rates, okay, if it forms part of your employment income. And then if you are a non-resident individual, it will also be taxed at 25%. So you need to understand what the tax implications around this transfer will be. And then you go ahead to look at whether there are tax planning avenues that you can use in the process of transferring this asset to be able to maximize your benefits under the law. And a clear example is the trust, which I cited earlier, and then also the will, which is transferring under a will. These are the key tax considerations, and I will encourage all of us to share the knowledge on these to people who are planning their estates. And just as Mr. Ifa and Mr. Arthur have already said, we don't need to wait till we die. We can actually start planning from now. If we are planning and giving it out in the form of a gift, we need to look at it from that angle. If we are including it in our will for it to be transferred ultimately to the beneficiary, after our death, we need to also look at what the implications will be for this recipient when they ultimately assume ownership of the asset. Thank you very much.
Thank you so much, madam. Oh, do again.